The topic of our presentation is providing business acquisition advice to a new client. Let's move on to the next slide. It is about the forms of organization. In sole proprietorship, the advantages are: this process keeps the requirements and the main needs of the company's activities simple and easy to handle, as it helps in individual decision making and does not let the confusion and complexity get created through different partners and owners. In cases of sole proprietorship, the owner is not bound to introduce, involve, and most importantly, publish its balances and the financial accounts of the business's activities under any circumstances. And the disadvantages are: the funds of the business activities are limited to a particular boundary instead of being unlimited. Due to this, the growth and the expansion of the company are not very vast in comparison to the other companies. As the financial resource is limited, the company stays small. The proprietor's liability is unlimited, which is not good in terms of profitability and self-liability of the owner. Due to the unlimited liability, the sole proprietor is discouraged against any expansion of the business. The proprietor's liability is unlimited, which is not good in terms of profitability and self-liability of the owner. Due to the unlimited liability, the sole proprietor is discouraged against any expansion of the business.
I will be explaining slide 4 and 5 of this presentation. So what are assets? Assets are the economic benefits of future that is controlled by the business with the expectation that it will generate future cash flows. It is the consequences of past events and transactions. So if there is increase in asset, that is generally due to profitability, but if there is decrease in assets, then that shows the financial position of the business is not healthy. Moving on to the liabilities part. Liabilities are the sacrifices done in future and which is based on past transaction and events. Liability, it is usually the sum of money which is used to finance the operation of the business. If there is increase in liability, that means the company's efficiency and profitability are lacking at its core. But if there is decrease in the liability of the company, that means the financial position of the company is healthy. Moving on to the next slide, business worth advice. So according to the question, the asset stands at $170,000, liability stands at $100,000, bank loan stands at $40,000. So the business worth of the company stands at $110,000. And the question also states that account receivable and inventory overdue is valued at 60 days. So because of this reason, the company the figures showed are not true and accurate because it doesn't take account receivable and obsolete inventories in consideration.
So guys, I am here Prince Sen. I would like to start by summarizing the whole thing which is discussed by my other group members. So first of all, start with the introduction. As in introduction, there are some parts which is tell about the company's balance sheet and also tell about how to analyze the different parts in the company. So after the introduction, there is a form of organizations, which are the two type of organizations. First is the sole partnership and then the partnership firm. So in the sole partnership, the business is only run by the individual and owned by the individual partner. So in the partnership firm, there is a contractual partnership firm. So moving to the next part, there is a assets and liabilities part. So after the asset and liabilities part, there is a business worth advices, in which the advices are given how to run the business and how to manage the business. So after these advices, there is a correct measurement part, and along with the correct measurement part, there is the next part which is the business financing decision. So these two parts tell about how to make the correct measurement in the business, and the business financing decision tell about how to make the decision in which in the some situations. So after these all things, I would like to go on the conclusion. So in the conclusion, that is tell about how the affirmative use of financial information and knowledge that helps to understand and make the right decision about the component of the balance sheet of the company and income statement, which helps the researcher or the investor to find the accuracy of balance sheet information and the strength of the company or the company's gain profitability in the right way. So thank you guys.